So the first pattern we're going to look at is essentially a smaller version of the triangle coil shaper pattern we spoke about in the shapers section. The only difference is I don't require the same parameters as I do for a shaper pattern. So the shaper, can only be 35% deep, and really it's the time element where you want at least 7 weeks to take place. Here, these patterns can be much shorter, and typically they're even shallower as well, but you need to use them in the context of a shaper pattern. So that's the difference. Although they're shorter, I won't use them alone just along the trend. I really want to use them within and around a shaper pattern, just as I use all these other tactical patterns. So if we take a look at Facebook, really what we're looking for is 3 touch points on an upper trend line, and you want to see a reduction of volatility throughout the pattern, which is really easily noticed here by the fact that you have a triangle pattern forming. And that really sets up a great low risk entry point where when you break through that upper trend line, you know that the volatility is reigniting on the upside and it's easy to buy the stock. So in this case here, I've blown up the picture so you can see it larger on the left-hand side. And this is a rare case. I guess we'll start here with a more of a rare case, but you kind of just barely get above the trend line in the situation here. So in this case here, I would use the low of the prior day as my stop. With most of these patterns, simply the low of the breakout point or the expansion point is where you can place your stop, because at that point you know the expansion is not following through and you're wrong on your thesis that there's a breakout happening. So in this case here, we have an initial risk of only $1.50 by placing our stop below this low, and even very quickly we get to 5 times our risk. Now earlier on I mentioned how I'd always want to have at least 5 times our risk whenever I'm trying to take a position on. And I want to show you, I'm going to indicate in all of these tactical patterns at what point we have 5 times the initial risk, because it seems like a tall order, but if you're really patient and you put all of these patterns together within the context of a shaper, you really have controlled risk with very large upside. So you'd be amazed at not only how often you get 5 times your risk, but even a multiple of that. So Facebook here was basing out along its 50-day moving average, and we had a substantial move higher. And after a break lower, we shaped up a new base, and right at the bottom of this base, again, we're above the 200-day, but we were coiling below the 50. We had another great coil pattern. We had 3 touch points to the upside. We had a tightening of volatility throughout the pattern, and we broke out above this bar. We could have placed our low right below the low of that bar, making only an initial risk of $2.25. Not too long afterwards, you had 5 times your risk. This took a little bit longer, but never really had you in the deficit column. And eventually you gapped higher on earnings and the stock went substantially higher from that point. And so really bring all of this together, the fact that, again, you have those 3 touch points on the upside really shows you that it's a valid trend line. So you could really draw trend lines anywhere if you use 2 touch points. It's just, 2 touch points are available anywhere on the chart. But the fact to have 3 well-defined touch points really shows that you have something substantial going on, and that's a real line of resistance. And that's what we're looking for. We're looking for a coiling of volatility, a real line of descending resistance that is broken to the upside. And you'll see as we go through multiple charts, this occurs all the time, and it has a great risk-reward setup. Next, we'll take a look at Netflix. Again, we're going back to a stock we've spoken about before. And after that big drop of 80% in 2011, Netflix reset up and started its monster trend that we all know it for today. And after an earnings gap here on the left side of the chart, the stock basically consolidated for about a couple of months, and we had this great 3-touch trend line. You can see we touched at 3 points exactly, and you had a coiling here, whereas the volatility was diminishing throughout the pattern. Now, as we break through that trend line, and in this case here, I love to even buy above the high of the last touch point, provide a low risk entry. You had a really initial $1.10 risk, and actually quite quickly you made 5 times your risk. That, when we pulled back, which is absolutely normal after a breakout move, and as this trend continued, you reached 13 times your risk along the way, and eventually 19 times your risk. And the stock even went much higher after that. But it's just so crucial, and this is where I'm really going to try and point out with all of these fantastic patterns, is that the ability to lower that risk to a point where it's so small versus the upside really provides this asymmetric setup, this point where you have very large upside, very little downside. And you really want to bring together all the tools that you can at your disposal. So not only were you correcting up against a 50-day moving average, which is a typical place of support, You also had very strong relative strength. The market had corrected significantly between May and July, whereas Netflix just basically went sideways. So you had that great A-B setup that we looked at early on the shaper part of the course for NVIDIA and some of the other stocks that were set up that way. And this really ties all of that in together. Next up is Shopify. We looked at Shopify multiple times, and here you can see this set up an incredible 5-touch trend line, just incredibly rare. And you can see right here, that last breakout, I kind of blew it up right here at the bottom, but as we broke through that upper trend line, we had an initial stop of $12, which seems like quite a bit, but this is a $300 stock at the time. And we never took out that low. And so relatively quickly, we were at 5 times our risk. And just a couple of months later, we were at 23 times our risk. So it's amazing that multiple times your risk becomes so much easier when you can really initially find that low risk entry. We had our very strong prior uptrend. We are in a corrective phase, which is absolutely normal after a strong uptrend. And all of this was within the characteristics of a proper shaper pattern. And this trend line break, which occurred here, was a great touch-off point to establish an initial position. The next pattern I want to talk to you about, I really call the mini coil. Essentially, the coil pattern we just discussed can happen over a number of weeks. It requires 3 touch points. It takes time to develop. Those don't happen over a short period of time. However, there's one pattern I really like is the mini coil, and I use this all the time. It shows up relatively often, and it's got a great low risk and a rather immediate upside move if the pattern develops properly. So if we take a look here at Callon Petroleum, CPE, this is a stock that was a huge winner in 2021 this year with the oil comeback. And you can see as we corrected to the 10-week moving average after this first initial major uptrend, we had this great mini coil that took place. Essentially what we're looking for is an initial session, which here we can see this big green candle, and you want at least 2 more bars, 2 more days that do not exceed either the top of that initial bar or the bottom of that initial bar. This pattern here is a less common variation of the mini coil, whereas there were 4 days that stayed within this initial day's range. But essentially the reason I call it a mini coil is that you have this initial day and all the price action after that day is contained within the first bar, so you have a tightening of volatility compared to that initial expansion. So the same underpinning logic that took place for the coil tactical entry or the shaper pattern coil are there again, but on a smaller time frame. And this is really using these bars, these charts, to bring that demand and supply balance into view in an easy to use way. So the second we break above the upper end of this range, you can quite simply put your initial stop at the low of the last bar before it broke away. And if we break the highs and then we take out the lows of the prior day of the breakout, I mean, you know that the breakout is not working, that sellers have come back into the picture, so you can quickly exit with a very small risk and try again at another point in time. So you can see here, so in February, as we approached the 50-day moving average, again, prior uptrend with substantial upside volume, we had this great mini coil that took place along the 50-day moving average. As we broke out on this green candle, all we had was an initial risk of 90 cents, and very quickly we were at 5 times our risk, and not too long after that, we were at 30 times our risk. Again, this was probably a great version of this pattern in terms of the upside, but even 5 times your risk, if you do that multiple times, it's going to really put you in a position where you're going to advance your account rather significantly. This next example of a mini coil is on Crocs. So you can see here we had a really nice large cup base, and we gapped out on earnings. And we'll see there's multiple buy points, multiple scenarios here, but you'll see that, again, we want to try and buy within 10 to 15% of a prior basing structure, of a stage 1 or stage 2 base, or within a test of a 10-week or 50-day moving average. You don't want to apply these patterns once the stock is too far extended from a base, because the odds of the stock correcting are much more significant. So the fact that we broke away from a base, and very soon after, we had a thrust day with 2 days within that range, setting up a perfect mini coil. We broke out above that bar with an initial $1 risk, and it kind of came in a little bit after that, but never took out this low here of the day before the breakout. And we very quickly advanced to 5 times our risk. Eventually we hit 11 and 25 times our risk not long after that. And it would all set up with this great mini coil after a breakout from a cup base. There's another great example. This is Roku. So we covered this cup with handle in the shaper section. And I just want to especially use this example here because you'll see how all of these patterns come together. Again, if it starts to become a little overwhelming, there's a putting it all together section for buy techniques. So there's also the putting it all together section that encompasses the entire trading strategy. And if ever, you can jump to those to kind of see how it all works together. But this is a great example of how we had a cup with handle base. We broke out, but there wasn't a lot of initial follow through. If you look here, we broke out, we had 2 days that nested inside that first day, creating that coiling pattern over a 3-day period. And when you broke above that first day, all you had was an initial risk of $5.50, again, on a $130 or $140 stock, which is relatively minimal, and you had a quick expansion to 5 times your risk. And what's great about having that initial move of 5 times your risk, even if you plan on holding this longer term, is that you have such a profit cushion now that even if there's a normal correction, normal sideways action, such as what Roku did here, you have enough cushion to sit through that and not be worried about losing money, and you're sitting at a profit the entire time. So again, very simple pattern, very effective at controlling your risk and giving you a precise entry after a breakout from a cup and handle base. Here's another example of Shopify. We looked at this in multiple ways so far, and I'm going to keep using the same stock charts over and over in different ways just to show you how there are so many ways to enter into a major winner. You don't have only one way of buying. Again, that's the real benefit of using these tactical entries versus shaper patterns alone, in that you have all these great ways to buy these fantastic stocks that have this huge upside but limiting your risk, which is just so crucial. And you look here, again, similar to Roku, Shopify kind of broke out of this huge cup base. And here the handle is what traditionally is called a high handle, in that the handle, the sideways period, took place above the left side of the base. But in terms of a mini coil, this is a really uncommon situation here where you had 1, 2, 3, 4, 5, 6, 7, 8, 9 days that were within the range of that first reversal bar at the top of the cup base. So although we had that reversal, which probably took place because you had pretty much a straight move off of the bottom, this reversal came in because there's obviously people who are sitting on substantial profits. There's people who bought on the left side of the base who want to sell their position because they're stuck with a loser and they're happy to get out. Regardless, you ran into some supply, but instead of coming down, you just nested. You just coiled up within this first bar. And when you finally broke out here on this day here, you had an initial risk of $49, again, on a $700 stock, completely reasonable. And after a few weeks' time, you're sitting at a 5 times your risk. So this is another great example of how you could have entered Shopify or used it as a way to pyramid further into Shopify for substantial gains in its bull run. Here we're looking at Square, and you'll see how this pattern can show up multiple times in a stock's advance. But we had essentially a beautiful 3-touch trend line here, a pattern forming. And on top of that, we had a mini coil right at the end of that pattern, which further tightened your risk. And so we had that first bar, we had 2 days nested within that, and your initial stop would be the low of that last bar before you broke out. And we broke out of that bar here. Again, you backed off a little bit on that day, but the day after you followed through and you started a substantial move higher. So you had an initial risk of 70 cents, and relatively quickly you were at 5 times your risk, and soon after 10 times your risk. Again, if you're holding for a longer term move, it's just amazing to have that kind of a return compared to your risk, because there is going to be that period where you get a sideways consolidation, just as you did here. And it's not a comfortable feeling to sit from a move from, almost $26 a share back down to $22 a share on this bar. I mean, it's a substantial turnaround. But if you have a large enough cushion and you understand the story and you have that kind of a multiple of your risk, it makes it that much easier to sit through it. And as you can see here, after a substantial amount of consolidation, you actually formed another beautiful mini coil right at the end of that pattern. And we broke out with strong volume of that pattern. And you can see here with an initial risk of just 80 cents. And very quickly, you were almost at 5 times your risk once again with your new add-on point. So you'll see how so many times this pattern keeps coming up, and it's really an effective way to find a short-term entry within a longer-term setup. The next pattern I want to cover is what I call the doji flag. So this is, I have this in the section of coil patterns because the flag is a period of calmness, but it's kind of a combination of an expansionary or a breakout technique with a coiling pattern. And so it's a little bit unique in that perspective. And essentially this pattern typically shows up after a breakout has already occurred. It's a way typically I like to use to add to a winning position rather than start one unless I missed the original breakout. Similar to a high tide flag, it's a rarer pattern to see, but it's also just like similar to a high tide flag, it tends to lead to stronger upside moves because you have a prior expansion phase. So if we take a look at First Solar, which was a big winner back in 2007, was again actually recently in 2020, we can see we had a strong prior uptrend, we had a small consolidation sideways, and as we broke out of that consolidation, we had a first initial thrust day here, a large upward candle. Then we had a doji, which is a day where the opening and close is relatively close, usually within 25% of the day's range. If ever your candle patterns are widely discussed online, there's just so many easy ways to find out some detailed information about the basics of candles. And so once we had that big thrust day and we had that next little small doji, once we gap away from that doji, that's your trigger, showing you that the momentum that started 2 days ago at that thrust day or that flagpole is continuing to the upside. Now, using this just anywhere will not give you the same kind of returns as it will as nesting it around a shaper pattern or around the 50-day moving average. It's just so important because sometimes if the stock has had an extended run, a pattern like this can be a climax or a blow off. I mean, it's just had such a strong run, and this is people just, falling victim to FOMO and chasing in and paying any price. So really, you want to use this soon after a breakaway from some kind of a consolidation pattern like you see in this example. Now, once you buy that gap away from that doji bar, it's really quite simple. If the stock were to take out the close or the low of the prior day, you know relatively quickly that you're wrong. I mean, if we're gapping higher and our assumption, our thesis is that we're continuing that momentum, well, if you go negative or you take out the prior day low, I mean, that thesis is broken. So you know very quickly if you should exit and take that small loss. So in this example here, we had a $1.80 risk. We bought on that open, and very quickly we had 5 times our risk only within about a week, and soon after that 24 times our risk. So again, it doesn't happen very often because you need both a consolidation and a breakaway move and a doji flag. It's a little more difficult for it to come together, but when it does, you tend to get these very explosive moves similar to a high tide flag. Here's an example of Fastly. Again, now this is a pattern I actually used in 2020, and Fastly was one of my biggest winners for the year. So we had this great breakout of this cup with handle. We ran up and we built a small consolidation, which is arguably a high tide flag in and of itself here. We can look at that at a weekly chart later. But we had a breakaway day from that consolidation, which you see here, which is the thrust day, the flagpole. We have a small doji day where you kind of open and close at the same point, showing indecision, consolidation, a coiling of volatility. And then when you gap away the day after, you know very quickly that the momentum is reaccelerating to the upside. And you can put your stop at the low of the prior day. Here there was a $3 risk, and very quickly you had a 5 times your risk, and soon after that 16 times your risk. Now here I tend to put my stop at the low of the prior day. It depends where the close is. If you want to be extra conservative, you can use the close of the prior day. I mean, if the low is just a little bit further, I'll give it a little bit of playroom. I think they're both valid arguments for either. What's really important is the overall setup of the pattern, the fact that you're coming out of a consolidation and you have that thrust day, a pause, and then a gap higher on that third day. And it's just, again, doesn't happen often, but similar to that FSLR example, it leads to a very quick move. Here we're looking at Farfetch Limited, again, another winner due to the COVID situation. They sell luxury goods online. And we had this really nice cup with handle pattern, fantastic. This is a stock I was watching myself in 2020. And we had this 2-day breakaway move from this cup with handle base. I guess you can argue the breakout was right here a little bit sooner, but then you kind of consolidated once again due to a very weak market. And this showed actually very strong relative strength in the sense that the market was breaking lower here in November, late October, early November, and Farfetch was making a higher low, setting up that great relative strength setup within the cup with handle base. And once we had that breakaway thrust move, we had a very small doji, small sideways consolidation of 1 day, and gapping higher signaled that there was continuation of that prior pattern. Similar to Fastly and First Solar, small initial risk of $2.60, very quickly at 5 times your risk and then 11 times your risk. So another great way that you could have initiated, but even more realistically added to a winner that you had already bought coming out of the base.